Wow, so much has gone on in just a month since the last rate decision, and it really goes to show how unpredictable things are these days. We've seen chaos in the banking systems across the world, and it's even hitting close to home here in Canada. OPEC surprised everyone by cutting supply, and the GDP and jobs numbers were way stronger than anyone predicted. On the flip side, Canada's CPI and PPI came in better than expected, and so it seems like forces are tugging in different directions, which does make it hard for the BoC. But according to a survey of economists by Reuters, all of them seem to think that the Bank of Canada will hold interest rates steady this time around, and they were right. We expected more tough talk, which we got, and we expected more talk about their wait-and-see strategy, which we also got. So in this video, I'll update you on the latest from the Bank of Canada post the April rate decision meeting and how this all ties into the Toronto real estate market. But before I do, check this out. This is a heads up that you can get our complete Toronto real estate investing guide for free on our website. You can see things like a breakdown of typical costs, rents, appreciation, sample financials that you can change up to see how it affects your returns, and even try out a quiz to see what might fit you best. I'll put a link to the free guide in the description below. Don't forget to like this video and subscribe to our channel so you don't miss other content like this made just for real estate investors in Toronto. The Bank of Canada's main job is to keep inflation in check, and it seems like they're making good progress these days. Inflation's expected to be around 5.2% in Q1 of 2023 this year, which is actually a bit lower than what was predicted at 5.4%. The latest Business Outlook survey lines up with the Bank of Canada's thinking that the economy will slow down in the middle of 2023 as well. And then OPEC's cutting supply means that they think that there's enough signs of a recession in the market that will slow down demand. And so that's why they're taking a step to cut supply to defend oil prices. Our economy is doing better than expected, and so the BoC pushed back their pace of slowdown into 2024 now and expect our economy to grow slowly but more evenly in 2023 and 24 before GDP picks up back to 2.5% in 2025. And in terms of inflation projections, they're seeing CPI fall pretty quickly this quarter, Q2 of 2023, back down to 3%, way faster than previously expected, and then back down to target at 2% by year end of 2024. These days, our big banks pretty much all agree that the Bank of Canada is done with rate hikes, but when the BoC might start to cut rates is still up in the air, and the banks have pushed back when rate cuts will happen from the end of this year, 2023, to Q1 of next year. And probably the biggest reason for this is because the job market is still super tight. But honestly, since the next move for rates is probably down and not up, the latest on rates has been positive for real estate. Now, ever since the Bank of Canada said that they'll pause rates last month, bond yields started to come down and lower fixed mortgage rates. And so that's why the market has been picking up pretty quickly in March. There's more buying confidence these days, and slightly lower rates do make it possible for prices to come up a little bit more. Listings are still way down from what we'd normally see, and so the competition out there is feeling a lot like how it did back in early 2022. The latest data from Trev for March confirms this, with the sales to new listings ratio hitting close to those same levels again. But here's the thing, even though we are seeing offer dates and multiple bids again, buyers are actually being more cautious this time. They're putting in conditions, making reasonable offers. So while prices are going up, they're not shooting up quite as fast as they did back in early 2022. Now, looking ahead, fundamentals are improving whether you like it or not. Rates are probably going down instead of up the next time they change. Rents are still going strong, and immigration targets are set pretty high. And yes, investment houses in Toronto can still cash flow, and we're expecting a lot more room for growth in the future too. Our city is working hard on making it easier to increase density to create more housing supply for a growing population, and that just means more rental income potential for you as an investor if you're willing to take on the work. Now, we don't know when exactly these policies will take effect, but it's probably sooner than later, and we're expecting it to be ready by the spring of next year in 2024. So, if you're looking to get into real estate investing in Toronto again, we're happy to update you on what's been happening and what the best opportunities might be. Just reach out to us by heading to the link in the description below. We're a real estate sales brokerage that focuses on investing in houses and multifamily homes in Toronto, and here's how it's like to work with us. First, we'll do a discovery call with you so we get to know each other more and help you get your financing ready, and then we'll teach you how to analyze deals. Once you're set, our sales team will work with you to find the best opportunities on the market and eventually help you buy the best one for you. Houses typically need a bit of renovations and we'll help you with a detailed scope of work and contractor connections. And then once you're ready to rent out the place, we also have leasing and property management services if you need it. So if you want to learn more about any of this, just head over to our website at the link down below. Again, don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. You can also head over here to check out our other videos. Thanks so much for watching and see you in the next video.